Hi folks, Chuck Gibson from Financial Perspectives here. Well, that was an ugly week for the markets. In fact, I guess it turned out to be the worst start of a year since the beginning of the Great Depression. I want to give a quick update on where we stand and where we're likely headed. I thought the best way to do this would be via a short video. This is the chart of the S&P 500. I've added some indicators and notation, so it's a lot busier than normal, but each help to provide clues and useful tools in my analysis. First off, the blue rounded top that I first started drawing mid last year is still in play, as you can see. While spending the entire first half of last year above, price is now swinging wildly around, but for the most part is staying below the red 200-day moving average. As you know, this, combined with the fact that it's now pointing downward, provides a clear warning that things are not in good shape and caution is warranted. Notice how the 1865 level down here, it has acted as support 2 times in the past during this year-long plus consolidation. Notice also it's the same level we touched on Friday. This is a great example of support in action. Usually, the first touch of a prior support will create a reflexive move in the other direction, and that's exactly what happened. This green area here, called the Bollinger Bands, represent 2 standard deviations on either side of average. So when price closes outside the green area, either above or below, we know that is statistically significant and we should pay attention because price stays within the bands 95% of the time. Without all the statistical speak, the bottom line is that a move outside the bands tells you to expect a reversal soon, as you're seeing non-normal activity. In case it's hard to see, price was outside during part of Friday but closed inside, which is positive. In the upper pane, RSI momentum is showing an oversold condition as it closed under 30 for the first time a week ago Friday and then again on Wednesday. I have circled times when we have gotten into oversold territory in the past for reference purposes here and here. You can see once it enters, it tends not to stay there very long and you should expect to move higher, at least temporarily. The fact that it moved back above 30 out of oversold territory on Friday's close is a positive sign. I want to point out, because it may be hard to see, but not only did we move out of oversold territory, but at the same time form positive divergence, another positive sign to expect higher prices. Great chart readers only need price and volume to interpret, but that comes with years, if not decades of experience, as it's an art. Indicators, like the ones we used above, should be used to supplement price and volume interpretation. While we did not close with a reversal candle on Friday, we did get some positive news with volume. Notice how in the past, here and here, when price came down to the same 1865 support level, volume spiked that day. In fact, on those spikes, volume increased 25 to 30% or more above the average, which is indicated in the blue line. We look for high volume as it's an indication of capitulatory or exhaustion selling. When it occurs, it tells us that because of the very large number of shares being sold, we may be running out of sellers. And if sellers are done selling, and there are mostly buyers left, we know which way price will likely go. Notice how we got that exact same spike on Friday. The question is, did it flush all the sellers? While we got a good spike, I would have preferred to see it be higher. The greater the spike, the greater the chance of a temporary bottom. So, the weight of the evidence above, combined with other tools I use, tell me to expect a bounce here real soon. But as I said in a prior post, what is important is where we go from there. Right now, the only thing we can say is that we are in a trading range between 1865 and 2130. A move above 2130 tells us the prior bull market is still intact. A break below 1865 tells us to expect more, maybe a lot more to the downside. My expectation short term is we see a bounce higher sometime next week, and that move will likely stall on or before the 1980 to 1990 level, as that has provided major resistance. My plan of action as of right now will be to liquidate most, if not all, remaining long positions and add to your short position if we fail to retake that level. On the timing front, unfortunately, it's possible that this will take many days, possibly weeks or more to unfold. So we need to ignore the daily wiggles and focus on the bigger picture here, which is the possibility that we have begun the start of a much bigger correction or the possibility of a new bear market. I do think a retest of the 1550 level we touched back in 2000 2007 and again in 2013 is likely if we really get moving to the downside. Keep in mind, the markets remain fragile, dangerous, vulnerable, and erratic to say the least. Volatility is extremely high and stock prices continue to prove to us that anything can happen. Fundamentals don't matter in these kinds of markets, which is why capital preservation is the primary goal. It's also important to remember, because of our cautious stance, we will outperform during market declines, but underperform when it rises. This is by design. Our goal is to minimize losses because the more you have when the markets eventually turn, and they will turn, the more you're going to be able to make. Remember, investing is a marathon and not a sprint. That's it for this video. Thanks for your time. I'll do my best to keep you all informed, and if you have any specific questions, feel free to shoot me an email. Have a good holiday, everyone.